In the territory of the modern financial empire, there exists a ghost-like behemoth. It produces no physical commodities, yet with an annual throughput exceeding $7 trillion, it absorbs the largest cash flows on the planet. It never participates in aggressive speculative myths. Yet acting as the world's most formidable, ultimate old money, it silently manipulates the underlying lifelines of sovereign bonds and transnational infrastructure. From top-tier hedge funds on Wall Street to the daily necessities of every ordinary household, almost all economic activities of human society pay a safety tax to this massive machine. This is insurance. Today, we will tear away the contractual disguises wrapped in complex terminology, dive deep into this risk crowdfunding campaign participated in by all of humanity, and analyze the most precise perpetual motion machine model in modern financial history. Human risk management was initially a gamble filled with theological overtones. In the Code of Hammurabi of the 18th century BC, Babylonian caravans made the earliest attempt at mutual risk assistance in human history through clauses that shared losses proportionally. In China, during the water transport system of the Song dynasty and the escort bureau system of the Ming and Qing dynasties, similar risk-sharing mechanisms also supported vast inland trade. However, the true qualitative leap of the modern insurance industry was bred in the raging storms of the Age of Discovery in the 17th century. In 1666, the Great Fire of London burned continuously for 4 days and 4 nights, reducing 80% of the city's buildings to ashes, which directly catalyzed the establishment of the world's first modern fire insurance company. Meanwhile, on the banks of the River Thames near the Tower of London, a coffee house named Lloyd's became the core intelligence hub for global commerce. Maritime trade at the time was highly lucrative, but the risk of shipwreck was extremely high. On the tables of Lloyd's, merchants began playing a high-stakes betting game. Shipowners would write their routes and cargo manifests on a piece of paper, and wealthy merchants willing to assume the risk would sign their names at the bottom of the paper, specifying the share they would cover. This is the etymological origin of underwriting, literally meaning writing underneath, and policy in modern finance. Insurance at that time was, in essence, a legitimate gamble by wealthy merchants on whether a commercial vessel could return home safely. The fatal flaw of this model lay in its extreme randomness. If extreme weather hit consecutively, the funding chain would instantly snap. The milestone that marked insurance's transition from blind gambling to a rigorous science occurred in Scotland in 1744. At that time, 2 ministers, Robert Wallace and Alexander Webster, sought to establish a long-running fund to provide for the widows and orphans of deceased clergy. To ensure the fund would not collapse due to premature deaths or unexpected longevity, instead of making sentimental estimates, they demonstrated an epoch-making financial rationality. Teaming up with mathematicians from the University of Edinburgh, they introduced the then burgeoning theory of probability, collecting and analyzing vast data on the life expectancy, mortality rates, and marriage rates of parish clergy. Through precise statistical calculations, they discovered that although individual death possesses absolute randomness in time and space, when the sample size expands to an entire social class, the macro-level mortality ratio exhibits an astonishing constancy in statistics. Based on this discovery, they calculated premium rates that allowed the fund to be self-sustaining. This was the Scottish Ministers' Fund, the true starting point of the modern life insurance actuarial system. From then on, risk management bid farewell to sorcery and gambling, officially falling under the dominion of mathematics and statistics. Now that we understand the history, let's look at the underlying financial logic of modern insurance companies. Why do you only need to pay $1,000 a year, yet the insurance company can pay you $1 million when something happens? How is this magic trick performed? To understand this, we need to dismantle 3 core concepts: the law of large numbers, the super asset pool, and the insurance company's sandwich profit model. First is the unshakable mathematical foundation, the law of large numbers. In probability theory, the law of large numbers states that the more times an experiment is performed, the closer the frequency of an event gets to its theoretical probability. For instance, Tossing a fair coin yields a completely random result on a single trial. But when the number of tosses reaches 1 million, the ratio of heads to tails inevitably converges toward 50%. The actuarial system of insurance companies thrives precisely on this. In a city with a population of 1 million, the incidence rate of critical illness for a healthy 30-year-old male over the next year is unpredictable on an individual level. However, in macro actuarial data, it is an extremely precise, fixed percentage, for example, 0.1%. This means that approximately 1,000 people are bound to be diagnosed this year. Based on this deterministic probability, financial engineering activates the second mechanism, the pool concept. Since it is predicted that 1,000 out of 1 million people will encounter risk, if each person requires $100,000 in financial compensation, the total risk exposure is $100 million. Actuaries simply need each of the 1 million people to inject $100 into the pool to build a super asset pool totaling $100 million. The few individuals who encounter risk draw funds from the pool, while the capital of the majority who do not face risk settles in the pool, using high-frequency, low-amount cash inflows to hedge against low-frequency, high-amount cash outflows. So, as the manager of this super asset pool, how exactly does an insurance company achieve capital appreciation? This brings us to the financial world's classic sandwich profit model. Risk. Premium represents the red line funds within the premium that are strictly used to counter risks. Actuaries calculate the probability of risk occurrence for a specific population based on macro-level laws of large numbers. This portion of the capital is legally mandated to be locked into statutory reserve accounts to cover future customer claims, and no institution is permitted to divert it arbitrarily. Meanwhile, loading fee acts as the fuel that keeps the insurance company's massive commercial machine running. As commercial institutions, insurance companies incur high operational expenses. The loading fee encompasses sales channel commissions. In many long-term insurance policies, 30% to 60% of the first-year premium is allocated as commission to brokers or agents, rent for office buildings in prime global locations, massive administrative expenses, and substantial brand advertising costs. Finally, there is the capital float. If an insurance company relied solely on charging loading fees to earn a channel spread, it would be nothing more than a run-of-the-mill risk intermediary. What truly places it at the very top of the global capital food chain is its unique three spreads profit model, which defines three hidden dimensions of an insurance company's profit sources. The top-tier mortality spreads refer to the discrepancy between the actual claim rate and the predicted rate. For instance, if actuaries predict that 1,000 people will suffer an event this year, but due to improved lifestyle habits, only 800 people actually do, the insurance company pays out for 200 fewer people. The money saved becomes the insurance company's profit. The mid-tier expense spreads involve the insurance company's operational and sales costs. When pricing a policy, companies factor advertising, employee salaries, and agent commissions into the premium. If internal management is highly efficient this year and actual operational expenditures are lower than what was pre-collected, the savings also translate into profit. Ultimately, the bottom-tier investment spreads serve as the financial nerve center and the most core profit engine within the entire sandwich model. Because there is an incredibly vast time horizon, often spanning decades, between the collection of premiums and the actual occurrence of risk, this massive pool of capital forms a tremendous time sediment within the asset pool. Insurance companies deploy this capital, which is entirely free from short-term liquidation pressures, into financial markets for long-term allocation, as long as the compound rate of return on their investment portfolio, for example, 4.5%, exceeds the pricing interest rate guaranteed to customers in the insurance contract, for example, 2.5%. The resulting spread forms the insurance company's most stable profit engine. The person who leveraged this underlying financial dividend to its absolute limit is none other than the Oracle of Omaha, Warren Buffett. The true foundation of Berkshire Hathaway's colossal investment empire is not its stock-picking methodology, but rather the staggeringly vast insurance matrix under its umbrella. In his annual letters to shareholders over the years, Buffett has repeatedly emphasized a core concept: float. So-called float is, in essence, deferred capital that has been collected but not yet paid out as claims within the insurance asset pool. Due to the unique inverted operational cycle of insurance, where money is collected upfront and services are rendered later, Berkshire permanently holds over $1,600 billion in settled float. In financial engineering, this capital possesses two terrifying advantages that commercial banks can never match. 1. Extremely low capital costs. Because Berkshire's insurance operations consistently generate underwriting profits, the actual cost of using this capital is often negative. 2. Immunity to bank runs. The liability side of a bank is highly susceptible to emotional contagion, leading to panic-driven runs. However, the liabilities of an insurance company are entirely governed by the law of large numbers and mortality rates. In this world, it is virtually impossible for millions of clients to queue up simultaneously to have accidents due to economic panic. This permanent leverage, which remains stable during crises and is free from redemption pressures, provides Buffett with the ultimate financial backing to execute ultra-long cycle, contrarian value investing when capital market bubbles burst. In this sense, while the tool attribute of a modern insurance company is risk hedging, its financial essence is that of a trust asset management titan, one that accumulates low-cost, long-cycle capital on its liability side and conducts full-cycle asset allocation on its investment side. Since insurance companies are essentially financial investment institutions, many viewers might worry. In recent years, the global financial circle has seen its share of turbulence, with news of bank failures, trust defaults, and stock market crashes being commonplace. What if an insurance company takes our premiums, invests them, and ends up losing everything? Or what if it encounters a catastrophic natural disaster or a widespread pandemic that leaves the asset pool unable to make ends meet? Will the insurance company collapse as well? Will our policies turn into worthless pieces of paper? The answer might upend your cognitive bias. In the modern financial architecture, insurance companies are arguably the safest and least likely institutions to fail in the entire society, surpassing even commercial banks in certain respects. To truly perceive the scale of this massive empire, we need to elevate our perspective to a macro-global economic dimension and dismantle the trajectory of its asset operations using authoritative data from top global financial think tanks. According to the latest Global Insurance Market Report released by the Allianz Group, gross written premiums, GWP, have crossed a historic milestone, steadily surpassing the $7 trillion mark. This implies that nearly $20 billion from the global economy flows into insurance asset pools every single day. However, on the global map, the distribution of this wealth exhibits extreme imbalance. Actuarial science relies on a core metric called insurance penetration, which represents total premium income as a percentage of a nation's GDP. In developed economies, e.g., US, Europe, Japan, average insurance penetration has long been maintained between 8% and 12%. In these regions, per capita policy ownership reaches 5 to 7 policies. The data intuitively proves that the more developed an economy and the higher its per capita asset size, the stronger society's rigid demand for risk hedging becomes. In high-growth emerging markets, current insurance penetration generally sits in the 3% to 5% range. Although the baseline is lower, its growth rate is 2 to 3 times faster than that of developed markets, making it the core growth zone with the fastest influx of capital globally. Over 60% of these massive accumulated funds are legally mandated to flow exclusively into sovereign bonds and national-scale physical infrastructure projects. They constitute the most resilient, patient capital in the entire macro-financial market. But when global natural disasters, geopolitical upheavals, and other extreme events occur frequently, do insurance company asset pools face the risk of liquidation? Sigma, The flagship research report by Swiss Re reveals the modern financial system's second line of defense, the reinsurance mechanism. Based on Sigma's analysis of payout ratio data for global catastrophic losses, even when confronting global extreme disasters, such as basin-wide catastrophic floods or global public health crises, large life and property insurance companies display a near-immune survival capability. The core secret lies in the secondary distribution of risk. After taking on large risk policies, no commercial insurance company retains 100% of the risk exposure in its own pool. Instead, like slicing a sausage, they cede 20% to 40% of the risk exposure and the corresponding premiums to global reinsurance titans, such as Swiss Re and Munich Re. Through this vertical financial engineering design, a localized catastrophic loss is ultimately diluted, hedged, and distributed across the global capital market. This unique liability structure, coupled with the rigorous dynamic monitoring of the solvency ratio by regulatory authorities worldwide, naturally immunizes insurance companies against panic-driven runs similar to those experienced by commercial banks, positioning them as the ultimate stabilizing ballast stone that is the last to fall in a financial tsunami. In the absolute worst-case scenario, where an isolated insurance company edges toward bankruptcy due to gross mismanagement, the laws of the vast majority of countries dictate that life insurance companies are not allowed to simply dissolve. The state will mandate that other soundly operating insurance giants forcefully take over all policies of the failing firm. In other words, even if the company you bought insurance from ceases to exist, your policy and the benefits you are entitled to remain legally protected and will continue to be honored by the acquiring company. This is precisely why you see news of banks collapsing and trusts defaulting, yet you almost never hear of a major life insurance company failing in a way that leaves ordinary citizens entirely empty-handed. However, the design of modern commercial insurance is exceptionally intricate. Leveraging an absolute informational and legal advantage, insurance companies construct an actuarial maze within insurance policies, woven from legal clauses and probability theory. Its underlying core logic is essentially using mathematical games to transfer or filter out risk, and the four modern core insurance types, medical, critical illness, personal accident, and life insurance, are modular extensions of this exact logic. First, actuaries utilize the waiting period and deductible to erect risk firewalls. Long-term health insurance generally implements a waiting period of 90 to 180 days to guard against adverse selection behaviors like insuring while sick, effectively eliminating claim risks during the initial phase of the contract from a probability standpoint. In medical insurance, an indemnity-based structure that reimburses actual expenses via invoices to hedge against steep medical bills. Actuaries introduce a fixed deductible to cleverly filter out over 85% of routine hospitalizations and minor day-to-day medical expenses across society. Data sourced from World Bank and Global Public Health Organization statistics. This allows companies to preserve the marketing gimmick of high coverage limits while causing actual claim probabilities and administrative adjustment costs to plunge off a cliff. Furthermore, medical insurance premiums scale exponentially with age, and its stability is fully contingent upon the renewability conditions specifically whether the insurance company can unilaterally deny renewal due to a deterioration in an individual's health. Second, the actuarial model enforces rigid constraints regarding capital turnover and derivative products. Because a massive portion of the premiums in the early years is front-loaded to pay channel commissions and underwriting costs, the policy's cash value during the initial years is extremely low. This creates a steep surrender charge that locks in long-term cash flow. This cash-locking mechanism is particularly prominent in savings-oriented and return-of-premium policies, endowment, and universal life. The financial reality of the money-back-if-you-don't-get-sick model is that the policyholder is essentially providing the insurance company with a long-term, low-interest, or even interest-free loan. The insurance company leverages transnational capital allocation to reap long-term compound investment spreads. eventually returning only the depreciated principal. The policyholder is effectively sacrificing capital liquidity in exchange for low-risk peace of mind. Finally, fixed benefit and high-leverage products address the financial shockwaves of extreme individual risks. Critical illness insurance utilizes a fixed benefit mechanism, paying out a lump sum upon diagnosis. It was conceptualized by South African cardiac surgeon Dr. Marius Barnard, who observed patients losing their income sources during post-operative recovery. Its essence is not to cover medical bills, but rather to serve as income replacement compensation during a major illness recovery period. Personal accident insurance strictly targets injuries that are sudden, external, non-illness, and unintentional by amount. Because the macro probability of an ordinary person encountering an extreme accident is incredibly low, it presents itself on financial shelves as a classic high-leverage product, using a nominal premium to leverage massive coverage, with its core metrics centered around the payout percentages tied to disability tier ratings. Life insurance hedges against the risk of mortality, designed to safeguard against debt and dependency crises when a household's primary economic engine stalls. It is split into purely consumption-based term life insurance and whole life insurance, which carries the certainty of an inevitable payout and is frequently used by high-net-worth individuals as a legal vehicle for transnational wealth inheritance, asset protection, or tax planning. Ultimately, insurance has never been the wealth miracle packaged by actuaries on transnational financial streets. Nor, of course, is it a worthless consumer trap. Once stripped of all marketing rhetoric, grand corporate headquarters skyscrapers, and psychological tactics, it remains, in its essence, a contract of risk transfer and distribution invented for human society over 200 years ago by those two Scottish ministers using mathematics and statistics. It leverages the law of large numbers to let the collective pay for the accidental misfortunes of the individual. Through the float generated by time horizons, it provides global capital titans with super chips to play long-term games in the capital markets. In this era, filled with volatility and uncertainty, understanding the underlying logic of insurance grants us an added layer of clarity and confidence to pierce through the capital mist when confronting modern society's complex financial derivatives. Pierce through the complex numbers games and let finance return to the most basic common sense. Thank you for watching today's video. Please click subscribe and hit the notification bell. Feel free to leave any insurance knowledge you know in the comments section. See you next video.